Good day, fellow investors. I don't think anyone on this channel was surprised with rates not being lower and to the bottom, but staying a little bit higher. And in this video I want to discuss the situation, the outlook, what can happen, what might not happen, will the Fed burst the current stock market bubble, and what does it mean for us investors? So let's start immediately with the situation. The Fed lowered rates a little bit. However, it also stated that further rates might not be as expected. Thus, the dot plot, let's say, is not going down as it was expected. It is a little bit slower, and therefore also it has a different impact on the markets, because before the cut and the announcement, everyone expected rates to go down pretty fast, and that is also what was priced in the market. Now the difference is this. This is from Bloomberg, and you can see that 2026 we were expected to already have rates below 3%, but now we are for 2026 already at 3.5 still, and far from the 2% or even lower what people were expected. 5, we were expected to reach 3%, and now we will stay at 4%. The key there is that in the long term it's likely not going to be 2%, but for now we are at 4%, and there is no indication that the Fed can lower rates much going forward given the current condition. And the median projection for inflation at the end of next year jumped to 2.5 from 2.1 in September. Thus, despite the current interest rates, 4%, inflation is not going higher. Thus, neutral rate estimates go up from 2% or even lower to 3% or higher. So when it comes to predicting interest rates, Jerome doesn't know, the Fed doesn't know, I don't know, whoever tells you that rates will go up or down doesn't know. Many of you were waiting for lower mortgages. Well, that is not happening now. So I always say we cannot predict rates. We need to see the risk and reward and invest in a way that whatever happens, we are okay. The points of the meeting, cut rates, that is what happened, but reluctantly as they possibly could. We cannot be sure they'll cut rates anymore. Markets, we have seen a 3% drop in the market for the day. That might be just the start if rates stay higher. We'll discuss this in a moment. And we have seen bond yields go up despite the rate cut. So from September, when the Fed started cutting rates, the 10-year Treasury went up from 3.5 to 4.5. Thus, that long-term tail of interest rates is going higher. The market doesn't believe in shorter-term rates, which is a reflection of inflation. The markets took a risk-off reaction, the VIX exploded that day, emerging markets went down, and the S&P 500 went down also, and even Treasuries went down on higher rates. This would be inverted in a normal world, but the thing is that inflation, when it's measured, I think central banks still look wrongly at it, because yes, 50 years ago inflation could be a little bit more local, but now inflation is global. And if we look at how inflation worked over the last few years, you can see that it goes up everywhere, then it goes down everywhere, and it is a little bit higher, a little bit lower depending on where you look, but inflation is now global. And they made research on how does unemployment impact inflation, and the rate should be like this. So improvements should increase inflation, but it doesn't work anymore, because now we have global factors that impact inflation: energy, commodities, food, global wages, and look at what has happened in China over the last decade. Wages more than doubled, so that is a 2x in wages, unlike 1x in Europe. So that is changing. We must understand that the emerging markets are home to over 4.3 billion people, and over the next decades they will compete for the copper, for the batteries, for whatever we want to. They are even younger than the developed world, much younger, and in the developed world we have just 1 billion people, not even against 4 billion people. Not against, but just to discuss the shift in inflation creation over time. Where is demand and supply? If there is growing demand on one side of the world, that will then overshadow the status quo that we have been enjoying for the last 20 years. We have been enjoying lower salaries, low wages in Asia. That leads to cheap products, but that now, with the demand from there, is changing. I'm not talking 6 months, I'm talking the next decade, and that is something that nobody in central banks is discussing or even contemplating. And now the question is, will the Fed burst our stock market bubble? And this is now the huge difference. In 3 months, the next year's Fed fund forecast moved from 3%, even a little bit lower, to 4%. When it comes to interest rates and asset values, everything is off interest rates, and the current S&P 500 earnings yield is 3.33% for a P ratio of 30. But when we push it to 4%, that is then a P ratio of 25, or if you add that on top of the Fed's rate premium for stocks, we should be looking at 5% at least. 5% means that the S&P 500 would need to go down to around 4,000 points. And that would be the rational way markets work, but we know markets are irrational and can't stay rational for longer. So on the question, will the markets crash? I have no idea. Because yes, if I look at earnings and if I look at Wall Street's highly exuberant earnings growth, that I don't know where it comes from, but okay, that is Wall Street. If I revert to the earnings yield or even to the mean, then we are in for a big crash, even bigger. I would not be surprised if the market corrects to 3,000 points, which is 50% down. Maybe there will be a recession, maybe the Fed will lose control on interest rates, on money printing, higher inflation. We don't know what will happen. I'm not here to do the predicting business, just discussing the risk and reward. And I wish I knew when or where this bubble will burst. I know usually in history bubbles always burst, but when it comes to current bubbles, we will see how the Fed will react, how will it manage. However, I think that we are somewhere here. Greed may be past, now we are at times of delusion, and new paradigm may be during 2025. Now, we cannot predict whether it's crash or not, it doesn't matter. We can only lay our investments brick by brick by brick, so that if it crashes, okay, if it doesn't, okay. You have to be invested in a way that whatever the Fed does, whatever happens, you are okay. That's the main message of this channel. And given the situation we are in the markets now, that's why I want to discuss this and really pound on this, because when the risk is high, I want you to be invested in a way that no matter what happens, you're okay. Thanks for watching. I'll see you in the next video.